We live in this world every day. We think about mortgages all the time. We think about repayments all the time. Most people don't want to think about this stuff all the time, right? They just want to go like, I bought the house, I'm going to put that aside. And especially in America, they go, I'm going to focus on investments, right? The share market, other ways to grow my wealth. I think that's a really key kind of difference between New Zealand and say the US in terms of how they think about their wealth.
We are back in your life, and today we are answering the question that I've been wondering for a while, Michael. Why does the US get a 30-year fixed mortgage and we're on 1 year to 5 year fixed rates?
Yeah, why can't we have nice things?
Yeah, I like nice things. Also, happy Halloween, Michael.
Thank you, James. Yeah.
We got a little Halloween party. This is getting filmed on Halloween for those breaking the fourth wall. What are you dressing up as tonight?
Gomez Adams. Yeah. That's why I got a moustache. I mean, the moustache isn't finished yet. It's going to go more Gomez this afternoon. But I was like, I can't roll a Gomez during this podcast.
We'll get Em to bring up a picture of that. I'm going to probably dress up as a shark, I think. And you might be like, why? Well,
because you're a massive fan of the Cronulla Sharks.
Nah, Cooper's dressing up as a shark to go Halloween trick-or-treating tonight. And I was like, well, I can be a shark to be like him, but also be a loan shark. Why not?
That's quite good.
Yeah, speaking of loans... it was actually quite interesting putting together these notes.
I know it's a lot of work.
I want to jump into the US model.
Yeah.
But let's just quickly recap. Most people will know how the New Zealand market works, but tell us how's it set up, Mike?
Cool. So mortgages in New Zealand, you can float them or you can fix them. I'm going to put aside all your offset and revolving because we're not really talking about that at the moment. If you float a mortgage, it is a variable interest rate. It can go up. It can go down. Your minimum repayments can also go up and go down. You can pay it off at any time without any penalty because it is a variable interest rate. So nothing is locked in effectively, right? A fixed interest loan is the opposite of that. So you are fixing in the interest rate, the repayment, and effectively the amount of time that you're fixing that interest rate for a period of time from 1, 2, 3, 4, 5 years, 6 months. And that is the limit basically of what you can fix in. If you choose to repay that loan partially or fully during that fixed rate period, there may be break costs where the bank goes, well, I gave you this interest rate for this amount of time. I expected to make this much money. I'm now not going to make that much money because you have paid this loan off. So I'm going to charge you the difference between what I have made and what I thought I was going to make. That's what we call a break cost.
So essentially we're fixing for quite short periods of time. Generally speaking, most people will not be fixing for 5 years. Most will be fixing between 1 or 2 years, generally speaking.
Yeah.
Which means the Reserve Bank does have quite a lot of control in terms of where inflation is sitting. A couple of really good examples is when COVID happened, interest rates went through the floor and we were at 2%. Then inflation spiked and we were like, oh no, this isn't good. So we ramped interest rates back up and people suddenly became poor very quickly.
Yeah.
Now on the flip side, we're like, okay, we need to get the economy moving. And I saw a stat coming out the other day that households have an extra 15% of their income because mortgage rates have come down. So that's the Reserve Bank can, for lack of a better term, manipulate the economy to derive an outcome that it
I think
needs.
that's a correct term. That's what they're trying to do.
Yeah.
And they do always talk about the lag, there's a lag with what we do, because there's people fix for 1 year. So if we do it now, people are rolling off their interest rates at different times. So it doesn't, pass through or translate through to the economy straight away. So they always talk about this lag because people are on fixed interest rates.
You want a real lag, Michael?
Give me a lag, James.
Let's talk about 30-year fixed mortgages, which is what the US model is all about. And it comes with a lot of certainty. It is wild to think that, imagine if you were like, all right, and it depends where you are in the cycle and what things are happening. Is it weird to think that you would fix a mortgage?
Every
for
time
30
I
years?
speak to someone from overseas, they think we're nuts. They're like, what do you mean you take out a loan for $1 million and you don't know what it's going to cost you? Like, what do you mean you don't lock the interest rate? And so what, it just goes up and down? And I'm like, yeah, it just goes up and down. They're like, that's like lunacy. Yeah. So again, I guess it's just kind of what you're used to.
Yeah.
But in terms of their model, they can choose, fixed interest rates for shorter terms or they can float their loans. However, they have the option to lock in the interest rate for the life of the loan, right? So on a 30-year mortgage, you can lock in a 30-year interest rate. There is certainty throughout that entire loan around what that repayment's going to be.
Yeah, which is just like especially if you think about when interest rates were 2 or 3%, imagine the amount of certainty that you would have over that period of time.
I have friends in the US who bought a house during that time. They're like, we're never moving.
Well, let's talk about, because that bit's very interesting. So let's break it down a little bit. So we're going to talk about a few terms. One is, firstly, there is the question of, well, if I get this mortgage rate, am I stuck where I am in that house forever? Is there the ability to move, Mike?
Yeah, you can move. So they can move banks. So they can refinance from one bank to another, or they can move house by effectively doing what we call a security swap, where you buy and sell on the same day. So, in New Zealand, if you've bought your first home and you're selling it and you're buying your next home, it's very common to do what we call a contemporaneous settlement, where you buy and sell on the same day. And what you can do in some instances is just swap the house out from underneath the mortgages, right? So you don't actually break the fixed term. You don't change any repayments, anything like that. It's just the loan was over house A and now it's over house B.
Yeah. So, I mean, there is some flexibility. You can also do, if you're on like a 7% interest rate and the market becomes a lot more desirable, I'm sure refinancing becomes very popular in that situation. Based off the research we've done, it does look like there is some, relatively significant costs. So if you had like $1 million mortgage, we're probably talking about $30,000 to $50,000, $60,000 that you might be paying in that situation.
Well, that sounds significant. And they call that a closing cost, right? Closing fee. It's kind of like the legal fees for transferring a house is how they define it, I think. I don't think it's that expensive to transfer a mortgage. But that is a relatively minor cost compared to what a break cost would be on that same loan, right? Like, or a potential break cost. Like if you had, because a break cost is defined by the interest rate that you took the loan out at, the current interest rate, and also the time left on that fixed interest term.
Yep.
So if you have 2 years left to run on a fixed interest rate, you got the interest rate at 6%, it's now at 4%, the bank's going to do you for 2 years of that difference of interest. Imagine them doing you for 28 years. Like that could be a giant sum of money.
Yeah, that's right. So the question is, how can they have this model that's so different to ours?
And why can't we get it?
Yeah, look, I think a lot of it does come down to scale.
Yeah.
So I did just have a look at I couldn't even find the number on the New Zealand mortgage market, but just to compare, right, Australia is much bigger than us. Their mortgage market, something like $2 trillion. The US mortgage market is like $12 trillion. It is quite different though. So essentially there are some very big players that the US government created called Fannie Mae and Freddie Mac. So you might be going, what are we at, a hip hop concert, guys?
Oh my God.
It's Federal National Mortgage Association and Federal Home Loan Mortgage Corporation. Pretty much they're not banks. They don't lend directly to borrowers. Instead, they buy mortgages from the bank and package them up as securities. Packaging up securities. I wonder what that sounds like.
Doesn't sound risky. It sounds like pretty straightforward. Nothing could go wrong there.
Yeah. So that gives the bank a lot more, security. It makes mortgages more affordable and more available. I think it's pretty much to do with scale, Mike, right? Like a much bigger market means that they can offer products that little old New Zealand can't offer.
Yeah, 100%. And it's not like there's no loan collateralization out there in the rest of the world, but pretty hard to bundle. You could probably bundle all of New Zealand's home loans up into one CDO and sell it, and that would be it. So yeah, it is a little bit more difficult. You would have to, just with the size of our market, fund on a kind of shorter term basis to get any real margin out of it.
Yeah. So the question is, right, if you've got this model, does the US have any control over inflation is high, we increase interest rates, we need to stimulate the economy, we decrease interest rates? How does the US deal with these things, Mike?
Yeah, well, they still do the same thing. It's just that it kind of impacts the economy slightly differently in the States, right? And you got to remember that the official cash rate or the Fed reserve rate doesn't just impact home loans, it impacts savings. It impacts other types of borrowing in the economy as well. So even though it may take longer or it may kind of impact the economy in slightly different ways, that federal funds rate will still impact the economy.
Business lending as well, right?
Yep.
That would be another one that would be impacted. So I think you look at it and you go, when you think about like 2008, 2023 in terms of like housing prices really increasing, if you see you're on 2 or 3% and you see interest rates move dramatically, does that really hurt you?
What was going wrong in 2008 where even though you had a 30-year fixed term, it was still tough?
I think there was some slimy mortgage brokers with mustaches who were giving out loans that they shouldn't have been giving out.
Maybe it's super low interest rates for a little bit of time.
Yeah. I don't know if you saw The Big Short, where essentially people got mortgages that they couldn't afford, and then it all started to fall on top of itself.
Yeah, I think there were some issues there as well with people going, okay, look, you can have a 30-year rate for, 4%, but the housing market is so hot right now. We'll give you an incentive rate for, say, 1% for 24 months, right? And in some instances, over leveraging. So we'll lend you 100 to 110% of the house value so you can make the repayments. So there are still ways where lenders can act in a way that's probably not responsible and trip people up like that. So again, yep, you have a 30-year rate, you've got to make sure you can afford that 30-year rate straight off the bat.
Yeah, and if you're in like a 2-bedroom house and it's your first home and you want to have a family and you want a 4-bedroom house eventually and you're seeing house prices increase, there will be a bit of FOMO going like, if I don't move now and the market's starting to move, I've got to jump.
Yeah.
The other risk as well is in terms of employment. So if interest rates go up and businesses are looking at lending, is there risk around your role, which can have an impact? So there are ways, if you've got like a solid job and you can keep your job and you can insulate yourself a lot more than in New Zealand, where TikTok, that rate's rolling off at some point and it's going to cause some pain.
Yeah, I'm like, maybe it's because I'm used to the New Zealand model, but I actually don't mind it. I think let's get into the New Zealand model and a little bit about the numbers after the break. If you're listening to us talk about 30-year interest rates, 5-year fixed interest rates, floating interest rates, and thinking, what should I do right now? Is my bank the best bank for me, or are there better options out there in the market? Get in touch with the team at Lighthouse Mortgages. We can give you personalized advice on your situation to let you know who the best bank, the best rate, and the best fixed term is. If you want to get in touch, click the link in the show notes below. Now, back to the episode.
Okay, let's break down, Mike. New Zealand versus the US. $700,000 mortgage. Let's keep it nice and simple. Hit me first with New Zealand.
Let's say you've got some middle of the bell curve interest rates. 4, a little bit low. 5, pretty middle. 6, a little bit high. You probably wouldn't fix for a really long term there. Your average repayment, if you sum all of that out, is going to be around that kind of 3,760, over the life of the loan. Sometimes it'll be higher, sometimes it'll be lower, but that's the average, right? So let's compare that to the US side of things. Let's say you've got a 30-year fix at 4%. That's going to be $3,350 per month. At 6%, $4,200 per month. At 5%, $3,760 a month. Now, the astute listeners who are very quick with their math will notice that $3,760 a month is the same as New Zealand's average repayment, right? On that average interest rate. So effectively what we can say is, if you lock in a 30-year term at 5% or less in the US, that is effectively going to be better than our system in New Zealand. If you're locking it in at 5.01% or higher, you would rather be in the New Zealand system having those fluctuating interest rates and repayments than you would be for fixing for 30 years.
You would have thought if the if the US market, where interest rates do get to those lower points, and that's probably reflective in like the economy and the housing market being in a tougher spot, people would be actually sprinting to go and get that 30-year mortgage.
Yeah.
It's opposed to New Zealand, you're just going to end up with a long-term average. Versus the US, there's particular points in time which are beneficial. And even if you end up high, if you refinance, there's a bit of cost, you still can end up on a better interest rate longer term.
Yeah, 100%. And there's always a trade-off, right? It's that certainty versus that flexibility. I think that's really what it comes down to here is like, yep, that certainty is going to reduce stress in the household. We know for a lot of people, budgeting stability of a fixed repayment is actually a really key reason why they fix their loans. And yep, let's say it's slightly higher than your average. Okay, you may be a little bit better in the New Zealand system, but actually for a lot of people, they'll go, you know what? I'm happy with this. You know, we live in this world every day. We think about mortgages all the time. We think about repayments all the time. Most people don't want to think about this stuff all the time, right? They just want to go like, I bought the house, I'm going to put that aside. And especially in America, they go, I'm going to focus on investments, right? The share market, other ways to grow my wealth. I think that's a really key kind of difference between New Zealand and say the US in terms of how they think about their wealth.
Yeah. Okay. So summarize, Mike. New Zealand or the US? Which model do you prefer?
Part of me wants just to be like USA, so I get to do that. But like, to be honest, I prefer the New Zealand system. I prefer the fact that, you know, we can fix for shorter terms. It can go up, it can go down. And we've got other products like revolving credits, offset facilities. And it just, to me, I think that's better because it means that you can take advantage of things when it's low and you're not stuck on that interest rate forever if it's high.
I gotta say, I like the US model because I just feel like USA.
Yeah.
And the reason for that is I just think that it's pretty much all upsides. Like either you get
boring.
You get the
lower. Don't have a job.
Yeah, you get the lower interest rate now, or you can refinance in the future at a bit of a cost and get the lower interest rate later on. And a lot of people want certainty. The other thing, though, it probably does mean is, you know, New Zealand's got one lever pretty much they pull.
Yeah.
In the US, you probably need to think about it in a bit of a different way.
But what? Like they pull that lever in the US, and what happens? Credit markets dry up. So maybe they have to pull a little bit harder. Credit markets dry up. And how does that impact the economy? You lose your job. I'd rather have a soft landing where we're not relying so much on job losses and we're actually on contractionary spending, as opposed to people just going, not only do I not have less money to spend, I now have no money to spend. So I prefer New Zealand.
All right. Well, let us know what you think in the comments. New Zealand versus the US.
Tell me how good my moustache is.
Yeah. And look, I guarantee you by the next time we film, it will be gone.
It will be gone.
One more time. Here's our Halloween outfits. James or Mike, who did it better? To be fair, Mike's put way more effort in than I did. I just rocked down to look sharp at 3:30 and was like, what's left? We'll wrap it up there. Make sure to subscribe, give us a review, give us a like, and we'll catch you next time.
Cheers.